Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. The Fed will announce the next rate hike on September 21st. It will be big as well. Just how big is a matter of debate. 75 basis points is a safe starting point, but 100 basis points will be on the table as well. 1% would match July's rate hike, the biggest since 1994. Now, desperate times call for desperate measures, and the Fed is desperate to push back against the highest inflation in decades. At least that is the message that they're saying. As I've said before, their actions aren't in line with their message, because if they were serious about inflation, they would raise the Fed funds rate by, say, 2% or 200 basis points to send a message to their fiscal policymakers to stop spending money. The Consumer Price Index, or CPI, is the oldest and most widely followed measure by overall inflation in the U.S. The Fed targets an inflation rate of 2% at the core level. I've yet had anyone tell me why the inflation rate can't be 0%. So if you have an answer to that question, reach out to me. I'd like to hear it. For a variety of reasons, the Fed dragged its feet a bit in responding to post-COVID inflation threat, as it has since been scrambling to catch up. Easy for me to say. That scramble is evident across financial markets. The typical reaction for stocks and bonds alike is to sell, sell, sell when the Fed sends unfriendly messages. When traders sell bonds, rates rise. Stocks obviously move lower when sellers are in control. The net effect looks like this. Back in January, the big wake-up call was the Fed's clear communication that its rate hike timeline would play out much more quickly than it did during the 2013 through 2018 tightening cycle. As Fed speakers made that increasingly clear via speeches and official policy communications, stocks and bonds continued to freak out. Once the market feels like it understands the Fed's mindset, it doesn't wait around for such speeches. If traders know the data that the Fed cares about, traders will react to that data itself. In the current case, things are fairly simple because inflation has no other competition for the Fed's focus. The Fed has two jobs: keeping inflation in check and to keep unemployment low. When this week's CPI data came out hotter than expected, traders knew exactly what to do. Thankfully, for consumers, the data actually didn't show much of an increase in overall monthly obligations, something best measured by the headline CPI as seen here. The headline number includes every price collected in the CPI report. It didn't rise at all in July and only rose 0.1% in August. That's the good news. The bad news is threefold. First, it was only as low as it was due to declines in fuel prices, and the fuel prices declines are due to lower demand. Second, the Fed famously focuses on core CPI, which excludes food and energy. And when food and energy are added into the inflation number, the number ends up being much higher than they want American people to focus on, especially right now before the midterm elections. The third piece of bad news is the data itself, where core CPI defied forecast by a wide margin, surging to 0.6% versus expectations to hold steady at 0.3%. If you noticed that the percentages in the last two charts are much smaller than the first chart, that's because these are month-over-month numbers. The first chart is expressed in annual terms, and it's in those annual terms that the Fed would like to see core inflation around 2%. Obviously, if every month was increasing at 0.6%, that would leave us at 5% in annual terms. Holy cow. Hence the sense of urgency in the financial markets and the rampant up in expectations for this week's rate hike. Now is a good time to answer the headline question of what really matters. While it's true that the market could experience a lot of volatility this week if the Fed hikes by 100 basis points or 1% instead of 0.75%, traders have been making much bigger changes to the Fed's rate hike outlook for the subsequent meetings. The traders simply make bets as to where the Fed funds rate will be after any given month's Fed meeting. The following chart shows how those expectations have moved over time for next week's meeting, actually this week's meeting, as well as those in December and next June. There's a lot going on in this chart, and I'll break it down for you following you taking a look at the chart. Okay, let's break it down in steps. First, note that the expectations for next week or this week's meeting didn't really move much in the bigger picture. A 3/4 or 75 basis point hike was 100% expected before the CPI data. Now there's a 20 to 30% chance of a 100% or 1% hike. And second, note that most of the big spikes in 2022 have followed inflation reports. Early August was an exception mainly for the longest term outlook. Number 3, note that traders already saw the Fed hiking to 4% by the end of the year before the CPI data, and now they see at least 4.25% with no relief by the end of 2023. Keep in mind, this will all depend on the unemployment numbers. If they begin to spike, expect the Fed to react with either a holding pattern or more of a dovish approach and start cutting rates. Simply put, the market got its hopes up for a friendly rate scenario by late July and has been forced to do an abrupt 180 degrees since then, both due to economic data and inflation reports. The past week was just the latest example. It happened to have an outsized impact because it's a highly uncertain time for inflation. Economists are looking for signs that inflation has turned a corner. Economists like Janet Yellen stating that the economy is strong and there is nothing to worry about. Keep in mind, she and Powell both said inflation was transitory. Kind of get that one. Forget about the forecast from a growing number of economists. It's the FedEx warning. Together with the initial 23% move down in stock price that has gotten the U.S. stock market to focus squarely on global growth fragility and related Fed policy mistakes. Economists were also worried about the possibility those positive signs were merely byproducts of plummeting oil prices. This week's core CPI data says that worry was and is valid. It doesn't help that the Fed speakers have said that they would let data determine the size of the next rate hike. But to reiterate, it's still not the size of this week's rate hike that matters most. What matters most, and in no particular order, will be the Fed's own rate hike outlook. Easy for me to say. This is conveyed in the form of a dot plot in the Fed's Summary of Economic Projections, or SEP. SEP is released at 2 p.m. along with rate hike announcement. It frequently moves markets far more than anything in the announcement itself, and thus frequently leads to faulty conclusion that the market is responding to the Fed's rate hike itself. In the case of the current meeting, the rate hike actually has more market moving power than average due to the uncertainty of the size of the hike. Now, let's connect the dots to how this impacted the mortgage market. Here too, it's not the Fed funds rate itself on the short-term outlook that matters as much as the longer-term outlook. The Fed has also fully exited its bond buying programs as of September 15th. Finally, Fed bond buying had been a major source of downward pressure on rates until they began to taper their buying amounts in late 2021. Now, here are a few side notes for anyone involved in the mortgage process these days. First off, note that rates first moved over 6% in June and were back above that line for most of September. Widespread media coverage of Freddie Mac's weekly rate survey led to the mistaken impression that this was a new development. It wasn't, as the Freddie Mac weekly survey is a lagging number. Even then, high rates might not be as frustrating for some borrowers right now, as is the lack of premium. Investors who buy mortgages historically pay a premium. Think of it like paying $310,000 on a $300,000 loan. Then count on earning that premium back with interest over time. When rates have surged much higher, and there's even a shred of hope they could stabilize enough to spark a refinance activity in the next few years, investors really don't like the idea of paying that premium. Why would they? This is one of the reasons for the now infamous prepayment penalty, which we don't have today, that existed before the regulations put in place after the financial crisis. In this environment, what would have been the prepayment penalty is now simply paid by borrowers up front in the form of higher closing costs. All that to say that it's very hard or even impossible to cover all the necessary upfront costs on certain loan scenarios simply by raising the rate. In the past, raising the rate got you more premium from the lender or investor. These days, that premium really isn't there or is simply too small to make any sense. This will change over time for sure, but it will require rates to be lower and much less volatile. Speaking of volatility, congratulations. You're living through an era that hasn't been seen in more than a generation when it comes to the persistence of exceptionally high volatility. Last but not least, word on conforming loan limits. This refers to the maximum amount of a loan that can be delivered to Fannie and Freddie, the two agencies that guarantee a majority of mortgages in the U.S. Conforming loans are typically more desirable than others due to lower rates and their streamlined standardization underwriting processes. The amount is determined by Fannie and Freddie regulatory, the FHFA. Conforming loan limits go up anytime home prices rise from Q3 to the following Q3 numbers. FHFA publishes the relevant Q3 data at the end of November, and loan limits go into effect for loans delivered to Fannie and Freddie starting January 1st. Because of that, lenders have increasingly gotten a jump on expected changes in the conforming loan limit. There's just one problem. As of this moment, we don't have any Q3 data from the 2022 home price data from FHFA yet. Lenders are guessing at the changes in the prices between now and then during this volatile time. Several lenders have pulled this trigger already this year, far earlier than last year. The magic number seems to be 715,000. If those lenders are willing to honor the lock commitments, even if the official loan limit comes in lower, that's their business and shouldn't have any impact on you. So if you're in that price range, take advantage of it. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.